In New York City, there are enough empty offices to fill 26 Empire State Buildings, while in Canada, we've seen the national vacancy rates hit all-time highs. My name is Trevor Miller from Cherry Hill Private Wealth. This week, we're going to take a look at commercial real estate, what's happening there. As I just kind of mentioned, there are some issues, definitely. Next, we're going to dive into the market update, see what's happened in the first half of the year, what we're expecting from the second half, and lastly, we're going to have a little bit of fun looking at Finland's way that they fine people for different infractions. Hope you enjoy. Working from home has been a luxury that many around the world are fighting to keep. And it's been one of the reasons that the commercial real estate market is stressed beyond anything we've seen before. In almost a perfect storm, as the work from home movement has been ramping up, there's been a huge increase in interest rates as well as the tightening of lending policies, especially what we're seeing in the US with regional banks pulling back their credit. Omer CEO Blake Hutchinson isn't concerned though. He said the honest view is that people are overreacting quite materially to this. On the other hand, publicly traded REITs are seeing investors dump their shares at huge rates. Capital Economics originally forecasted that the pandemic would cause office occupancy to fall between 7 and 8% by 2025, but then vacancy would rise markedly and remain elevated through 2030. They've now updated these forecasts and are now saying that the 35% plunge that we have seen likely won't recover by 2040. We've seen now 56% of firms adopting a hybrid model, causing vacancy rates to increase significantly. But what puts commercial real estate in a particularly vulnerable situation is due to the fact that it's largely built on debt. So we've got a lack of demand on one hand, coupled with increases on borrowing costs on the other. If you had a building that had exactly the same amount of tenants today as they did 3 years ago, and their debt is now maturing, they'd be in a really big problem as their debt servicing would be a lot more difficult to handle. With the hybrid model, companies will have the ability to hire wherever they can find them. But this also means that your office doesn't have to be in one particular place. And this is really what we're seeing in San Francisco. What was once the big tech hub has seen companies like Salesforce, Tesla, and Oracle, amongst others, taking their leasing dollars elsewhere. This has really been devastating to the California city, where office workers account for 72% of the area's GDP, or about $531 billion in 2019. So now, when it comes to commercial real estate, not all real estate is the same, and even different areas are seeing significantly different experiences. Office towers were once the hottest commodity to own heading into the pandemic. Downtown Toronto, for example, had a vacancy rate of 1.2%. But fast forward that to the first quarter of 2023, and that vacancy number hit an all-time high of 17.7%. So just a huge increase in vacancy in the city of Toronto. Even in this fairly narrow sector, newer towers with newer amenities, known as Class A buildings, are seeing higher occupancy rates and rise in rents, while less maintained buildings, known as Class B and Class C, are just emptying out. Looking at industrial properties such as warehouses, manufacturing plants, and distribution centers are seeing national vacancy rates fall into record lows of 1.6% by the end of 2022. So vacancy in there is almost non-existent. It's raised a little bit through 2023, but not a whole lot. Even rental apartment buildings have also performed pretty well since there are major constraints in a lot of the US and Canadian cities. When we look back at office towers in particular, there may be divergent opinions on the overall state. And as I mentioned earlier, the most sophisticated investors, such as major pension plans, and that's your OMERs and pensions like that, and family offices, are still very optimistic about the state of commercial real estate. The individual investors, on the other hand, are really shying away from the offices. And we see this in that the office total return index is down by more than 50% relative to the all equity REIT index at this time. The Bank of America analyst recently wrote that the challenges are real and significant, but for several reasons they are manageable. Morgan Stanley's CIO was far less optimistic. She wrote that more than 50% of the $2.9 trillion in commercial mortgages will need to be renegotiated in the next 24 months. So lending rates at this point in time can be up as much as 350 to 450 basis points from what they previously negotiated. They're forecasting a peak to trough price decline as much as 40%, which is worse than what we saw in the great financial crisis. PwC does not see the sector in crisis at all, saying that opportunities will be found. The Bank of America discusses their reasoning behind why they think the challenges are manageable, with a major reason being that there are financial tactics that can help avoid defaults, including loan modifications and extensions. But again, on the other side, even the Canadian Federal Bank regulator has ranked commercial real estate as the third most acute of 9 key risks it's tracking this year, with offices being the most under pressure. However, again, going back to the other side, a report put out by Remax Canada, they now predict that Canadian cities could see an upswing in demand for commercial real estate over the next 6 months. When constructing an investment portfolio, real estate has always been an asset class that has added diversification as well as steady returns. It's typically a significant holding for the wealthiest investors, and this really isn't by mistake. As we're seeing volatility in the office space asset class, there are still several areas that are doing exceptionally well. It wasn't that long ago. It might be a little bit long ago, looking back to the 90s, where we're seeing industrial land in Southwest Ontario being sold for about $1,000 an acre. But we fast forward to 2021, we saw those prices move to over $500,000 an acre in the Waterloo region. Again, this is really region specific, but by the end of the year, even those properties were hitting over $1 million per acre. So with everything from logistics centers to electric vehicle battery plants leading the boom, these prices have continued to rise in this area. Fiera Real Estate, for example, acquired about 21.6 acres in Brantford for around $118 million, while PowerCo has made home in St. Thomas on a 370-acre land, and that battery plant will have a price tag of about $35 billion when all is said and done. So regardless of what you're looking to do in the real estate world, it's really a good idea to have as part of your portfolio, but also at the same time making sure that you're being very diligent in what that looks like and what type of assets you're having inside this portfolio. Much like the consensus in the commercial real estate world, the state of the economy is largely being debated right now as well. I'm going to focus more on what the consensuses are and the parts that will really affect your family. But before I get into that, I just want to take a quick step back. We were previously partnered with one of the big institutions, and we had very few avenues to present to our clients with outside opinions. A major reason we partnered with Harbourfront was because of their immense strengths in the investment front. But that being said, this here comes from the quarterly reports of BlackRock, JP Morgan, RBC Global Asset Management, and then publications like Bloomberg and Investment Executive. I've, of course, included our thoughts and the thoughts on our investment team that we value very much, but I just want to make sure it was a nice rounded market commentary for you here today. When looking at the end of the second quarter, market performance was pretty underwhelming, especially when we were able to carve out the big 6 to 7 tech companies that have really been pushing the market performance in 2023. In fact, the top 10 companies in the S&P 500 account for 13.8% of its overall returns, and that's of the 14.9 return of the index year to date. So it's made up a very, very large portion of that. And when looking at the main storylines so far this year, the rise of artificial intelligence and the continued stickiness of inflation have definitely been the most dominant headlines. Now, according to the head of the BlackRock Institute, Jean Boivin, much of the inflation stickiness is due to supply issues, and this really isn't going to change in the next couple months. Inflation is really driven by a simple supply-demand curve. Raising interest rates can do a decent job of reducing demand, which could reduce pricing, but it really struggles to make an impact when the supply is the issue. In fact, it can actually have an inverse effect as companies are looking to finance increase in production or having to spend more on the capital debt servicing instead of production. In Canada, we had a surprise rate hike on June 7th, and then we had an additional hike that we all kind of anticipated on July 12th. So according to our team, we expect to see the impact of interest rate hikes to start impacting the economy over the latter part of 2023, which would align with the historical patterns of the economy slowing 12 to 18 months after the first rate hike, and we're about 12 months into it at this point in time. We've also seen a flat line of economic growth over the past 18 months, so although we haven't moved into recession territory, there's been definitely some stagnation here. JP Morgan is looking to take defensive positions on equities as they're seeing a struggling economy ahead, especially with the risks in the commercial real estate market. And our team also echoes these sentiments and is looking for returns in the floating rate bonds as opposed to the Canadian equity segment. With very similar returns, there's a little bit of lagging on the floating rate, 5.1 to 5.7 over the last little bit, but we're seeing a lot of protection on that downside risk that we're anticipating coming up in the next several months. Now, BlackRock has also mentioned that one of the opportunities they see is in the floating rates or inflation-linked bonds. All the companies that I had a look at mentioned that a set and forget it type investment strategy might have worked previously. Getting more granular in the investment strategy is going to continue to play an important role throughout 2023. So what does that actually mean? We've seen swings in the market that have included all companies in a market leading into and then throughout the pandemic. But in today's climate, the fundamentals of the individual companies will play a larger role in the investment returns. And as you likely know, Harbourfront is a leader in private credit, private real estate, and private equity in Canada. And we really believe that with the tightening of economic policies and less of an appetite for lending risks after the banking issues in the US, this should really create an opportunity for private credit to fill the void. BlackRock shares their sentiment, and here's what they said in their mid-year outlook regarding banks curbing lending, especially at the smaller banks. This presents opportunities in the private markets, including indirect lending or finance negotiated directly between a non-bank lender and a borrower. We expect more borrowers to turn to private credit as it becomes relatively better priced and given the certainty of execution and long-term partnership and private lenders can provide. So really great opportunity there. As RBC Global Asset Management noted, the range of outcomes that we're going to see here is very broad. With so many uncertainties in the markets right now and returns being held up by a handful of companies, now is the time to really make sure that you're diligent with your investment choices. A defensive portfolio that includes private credit can really help ensure that if a recession does come, as JP Morgan predicts, your portfolio won't be set back further. So some fun facts today that I just think that maybe not a lot of us are aware of. And I recently learned this as well. There's a few regions in Europe where fines such as speeding can be variable, like very variable depending on the severity of the infringement and the ability to pay by the rule breaker. So in a recent instance, a multimillionaire was hit with one of the world's highest speeding fines, and it was just over 104,000 euros for driving 30 kilometers over the limit, and this was in Finland. And in Finland, tickets are calculated on a percentage of the offender's income. So bad news for this chairman and founder of a $350 million a year holding company who was in his 70s. His comment on the ticket was that he was caught right as the speed limit suddenly changed from 70 to 50 and he didn't have the chance to slow down. I've used that one before. You've got the chance to slow down, and I will continue to use that. Hopefully it can get me out of a future speeding ticket. But fun fact is that the police have the ability to instantly check the offender's income via their smartphones through a central taxpayer database. Hence, they can determine and calculate the ticket on the spot. One may feel a little bit bad for this speeder, but again, fines are based on income and severities, and this gentleman was not new to speeding or large fines for his behavior, so this was definitely not his first offense. Back in 2018, he was fined almost 64,000 euros, which was 5 years after being hit with a $95,000 ticket for the same offense. So this was his third excessive speeding ticket, and he also had his license suspended at one point in time. Hopefully he used different excuses on each of them. And being the good Samaritan that this gentleman was, he did comment and say that, maybe a little bit tongue-in-cheek, that he heard the government wants to save more on healthcare in Finland, so he hopes that his money can help fill a gap there. Switzerland also has a similar income-based system and imposed the highest fine ever recorded. This was for going about 290 kilometers an hour, and the fine totaled 1.1 million. So anytime you're feeling a little impatient, need for speed, just do it, I guess, because, the most we're going to get here, I mean, like, maybe not 50 over, but the most we're going to get here typically is, hundreds of $200, which is a big drop in the bucket to a $1.1 million fine. So go have a little fun. Thank you for watching this week. As always, we'll be back in 2 weeks. Have a look on our social media pages for a couple of videos and commentaries each week on different topics as they arise. Please don't speed, even though I was making some jokes before. Take that money, put it in commercial real estate, or have a look at some good opportunities in the investment market as well. If you have any questions, please feel free to reach out to myself or anyone on our team. We're always happy to help and answer some questions. Take care, and until next time.